Most people hear the words digital dollar and immediately jump to one of two extremes. Some people think it means cash disappears tomorrow, every payment becomes monitored, and the entire financial system changes overnight. Other people hear the same phrase and think it is just another version of mobile banking, like using a banking app, PayPal, Venmo, Apple Pay, or a debit card. But both reactions miss the real issue. The digital dollar conversation is not only about a new payment method, it is about the future structure of money, trust, identity, privacy, cybersecurity, and financial control in a world where almost everything is already moving online. And here is the twist. Even if a US central bank digital currency never becomes part of your daily life, the questions around it still matter. Because the same issues connected to the digital dollar are already showing up in the systems Americans use every day. Online banking, mobile wallets, digital identity checks, fraud monitoring, instant payment systems, crypto platforms, stablecoins, payment apps, subscription billing, credit scoring, account verification. All of these are already part of a larger shift toward digital finance. So this video is not going to tell you to be scared of the digital dollar. And it is not going to tell you to blindly trust it either. Instead, we are going to do something more useful. We are going to break down what a digital dollar actually means, what Americans should realistically understand, where the real safety questions are, and how everyday people can think about privacy, fraud, cybersecurity, and financial awareness without getting lost in political arguments or technical language. Welcome to Cyber Safety Brief, where we explain simple cybersecurity and digital awareness topics for everyday Americans in a clear and practical way. This video is based on authentic, legal, and publicly available financial and cybersecurity information. Everything here is for educational awareness and understanding only. We do not promote illegal activity, financial advice, hacking, cybercrime, unauthorized access, or political positioning. The goal is simple. Understand the system better so you can navigate digital money more safely. Point 1. What is the digital dollar? The first step is clearing up the biggest misunderstanding. When people say digital dollar, they are usually talking about a central bank digital currency, often shortened to CBDC. A CBDC is a digital form of central bank money. In the United States, that would mean money connected directly to the Federal Reserve System rather than money that only exists as a balance inside a private bank account. Now, this is where people often get confused. A digital dollar would not simply be the same thing as the money you see inside your Chase, Bank of America, Wells Fargo, or credit union app. That money is already digital from the user's perspective, but it is still part of the commercial banking system. Your bank keeps records. Your bank processes access. Your bank provides the account experience. A digital dollar, in theory, would represent a different kind of digital money because it would be a liability of the central bank rather than a liability of a commercial bank. That sounds technical, so let me make it simpler. When you hold a physical dollar bill, that dollar is central bank money. It is issued through the official monetary system and accepted as US currency. When you see money in your bank app, you are looking at a bank deposit. It is still US money for everyday use, but it is held through a private financial institution. A digital dollar would be closer to central bank money in digital form. That does not mean it would automatically replace every bank account, every payment app, or every existing financial service. It simply means the foundation of the money could be different. In my opinion, this is where most public confusion starts. People hear digital and assume we already have it. And in one sense, yes, Americans already use digital money every day. But from a financial infrastructure point of view, there is a difference between digital access to bank money and a digital form of central bank money. That difference matters because it raises deeper questions about access, privacy, cybersecurity, regulation, and public trust. So before anyone argues whether the digital dollar is good or bad, the first thing they need to understand is what it actually is. It is not Bitcoin. It is not Venmo. It is not just your bank app. It is not a random online token. It is a possible form of official digital currency tied to the central banking system. And the moment you understand that, the conversation becomes much more serious and much more practical. Because now we are not just talking about technology, we are talking about the structure of money itself. Point 2. Why is this even being discussed? A lot of people ask a very fair question. If Americans already have debit cards, credit cards, online banking, payment apps, instant transfers, and direct deposit, why even talk about a digital dollar? That question makes sense. From the average person's perspective, money already feels digital. Most workers receive paychecks through direct deposit. Most bills are paid online. Most stores accept card payments. Many people carry less cash than they did years ago. Small businesses use apps for invoices, payroll, tips, and sales. Students pay with phones. Families send money through payment apps. So at the surface level, it looks like the digital shift already happened. But underneath that surface, money still moves through older layers of financial infrastructure. There are banks, processors, settlement networks, fraud systems, compliance checks, card networks, and intermediaries. The digital dollar conversation exists because central banks around the world have been asking whether public money should also have a modern digital version that fits a digital economy. In my opinion, this is not mainly about replacing what people already use tomorrow morning. It is about preparing for a world where financial activity becomes faster, more automated, more global, and more dependent on digital identity. What most people underestimate is that financial systems usually do not change because someone wakes up and wants a new app. They change because behavior, technology, and economic pressure move in the same direction for years. The public starts using less cash. Businesses start expecting faster settlement. Fraud becomes more digital. Cross-border payments become more important. Private digital assets become more common. Stablecoins grow. Payment apps become part of daily life. And then central banks start asking whether the traditional money system needs to adapt. That is the bigger context. It is not just about whether you personally want a digital dollar. It is about whether the financial system can keep up with the way people and businesses already behave. Now, that does not mean every CBDC idea is automatically good. It does not mean every concern is wrong. It simply means the discussion is happening because digital finance is already here. The digital dollar conversation is one part of a larger question. What should public money look like in a world where private digital systems are handling more and more of everyday financial life? And that is why this topic matters, even if you never plan to use a CBDC yourself. Because the design choices being discussed today could influence how money, identity, and payment safety work in the future. Point 3. Digital dollar versus crypto versus stablecoins versus bank apps. This is where the conversation gets messy very quickly. People often mix together the digital dollar, cryptocurrency, stablecoins, bank accounts, and mobile payment apps as if they are all basically the same thing. They are not. Let's separate them in plain English. A bank app is simply a digital window into your bank account. You see your balance, you send payments, you deposit checks, you manage cards, but the money is still held by a bank or financial institution. A mobile payment app is usually a service that connects to your bank account, debit card, credit card, or stored balance. It gives convenience, but it still depends on underlying financial networks. Cryptocurrency is different. Crypto is usually based on decentralized networks, where value can move without a traditional bank or central authority controlling every transaction. But crypto can also be volatile, risky, and complicated for everyday users. Stablecoins are another category. They are digital tokens that are usually designed to maintain a stable value, often connected to a traditional currency like the US dollar. But stablecoins are generally issued by private companies or organizations, not directly by the central bank. A digital dollar, or CBDC, would be different again. It would be official public money in digital form. That is why the debate is different. With crypto, the conversation is often about decentralization, speculation, ownership, and blockchain networks. With stablecoins, the conversation is about reserves, regulation, issuer trust, and payment use. With bank apps, the conversation is about private banking access and consumer protection. With a CBDC, the conversation becomes about public money, central bank design, privacy, national payment infrastructure, and legal authority. What I personally think is important here is that people should not use one label for all digital money. That creates confusion and unnecessary fear. A payment app is not the same as a CBDC. A CBDC is not the same as Bitcoin. A stablecoin is not the same as cash. A bank deposit is not the same as central bank money. These differences matter because each system has different risks and different protections. For example, your bank app might be convenient, but it depends on your bank's security and account policies. Crypto may give users more direct control, but that control also comes with personal responsibility and risk. Stablecoins may offer speed and digital access, but their safety depends on reserves, transparency, and regulation. A CBDC could offer official backing, but it would raise major questions about privacy, access, cybersecurity, and government limits. So the smart approach is not to say digital money is good or digital money is bad. The smart approach is to ask, what kind of digital money are we talking about? Who controls it? What protections exist? And what happens if something goes wrong? That is the kind of thinking everyday Americans need as finance becomes more digital. Point 4. How it could affect everyday Americans. Now let's bring this down to real life. What would a digital dollar actually mean for a normal person? A parent buying groceries, a student paying rent, a worker receiving wages, a small business owner accepting payments, a retired person receiving benefits, a family sending money across states. In a simple version, daily activity might not look dramatically different at first. You might still open an app. You might still scan, tap, send, or receive money. You might still pay bills online. You might still use banks and payment services. The surface experience could feel familiar, but the deeper system behind the transaction could be different. The payment might settle faster. The money might move through fewer intermediaries. Identity checks might be built differently. Privacy protections might depend on design choices. Fraud systems might work in new ways. Small businesses might face new payment options or new compliance questions. Consumers might need to understand new wallet systems, access rules, recovery options, and dispute processes. And this is where cybersecurity awareness becomes important. Because when financial systems change, scammers adapt. Every time a new financial technology becomes popular, criminals look for confusion. They do not need to break the whole system. They just need people to misunderstand it. Think about how many scams already use confusion around taxes, stimulus checks, banks, delivery companies, social security, payment apps, crypto, and online accounts. If a digital dollar ever became a serious public conversation, scammers would almost certainly create fake websites, fake wallet apps, fake emails, fake registration pages, fake support calls, and fake investment claims around it. That is why the safest mindset is not just what is the official technology. It is also how could criminals abuse public confusion around this topic. In my opinion, this is one of the most overlooked parts of digital finance. People focus on the official system, but they forget that scams often appear around the system before everyday users fully understand it. So if you are an everyday American, the practical concern is not just whether a digital dollar exists. It is whether you can recognize official information, avoid fake claims, protect your identity, and understand what real financial institutions would and would not ask you to do. Because the average person is more likely to face a fake digital dollar scam than to directly interact with a complex CBDC design document. That is the reality. Technology may be advanced, but most fraud still relies on confusion, pressure, and trust. Point 5. The privacy question. Everyone is asking. Privacy is probably the biggest concern most people have when they hear about a digital dollar. And honestly, I think that concern is reasonable. Money is personal. What you buy, where you shop, who you send money to, what bills you pay, and when you move funds can reveal a lot about your life. Financial data can show habits, routines, relationships, needs, problems, and priorities. So when people ask, would a digital dollar protect privacy? That is not a paranoid question. It is a serious design question, but we also need to be honest about something. Most modern payments already create records. When you use a credit card, there is a record. When you use a debit card, there is a record. When you send a bank transfer, there is a record. When you use many payment apps, there is a record. So the issue is not simply digital payments create data. That is already true. The real question is, who can see the data, under what rules, for what purposes, how long it is stored, how it is protected, and what rights users have. That is the real privacy conversation. In my opinion, privacy in digital finance is not a light switch. It is not simply on or off. It is more like a set of locked doors. Some doors should be available for fraud prevention and legal compliance. Some doors should be closed to unnecessary tracking. Some doors should require strong legal process. Some doors should not exist at all if they create too much risk. That is why design matters so much. A digital dollar could be designed with stronger privacy protections, weaker privacy protections, or something in between. It could involve private sector intermediaries. It could include identity verification. It could include transaction limits. It could include offline features. It could include safeguards against misuse, or it could be designed poorly and create serious trust problems. The technology alone does not answer the privacy question. Policy, law, governance, oversight, and architecture answer the privacy question. What most people underestimate is that privacy must be built in early. It cannot be treated as decoration added later. Once a financial system is built around certain data flows, changing those flows becomes difficult. That is why public discussion matters. That is why legal limits matter. That is why transparency matters. And that is why everyday people should not ignore this topic simply because it sounds technical. Because privacy decisions made at the system design level eventually affect normal people at the grocery store, workplace, small business counter, and family bank account level. Let me know in the comments if you agree with this. Should digital money systems be designed with privacy first, or should security and transparency come first? I would actually like to hear how people think about that balance. Point 6. Cybersecurity risks are not theoretical. Whenever financial systems become more digital, cybersecurity becomes more important. That does not mean digital finance is automatically unsafe. It means the stakes become higher. A financial system has to protect accounts, transactions, identity, access, records, availability, and trust. If people cannot trust a payment system, they will not use it confidently. And if criminals find weak points, they will exploit them. Now, it is important to be careful here. This video is not about explaining how attacks work in a technical or harmful way. We are not discussing hacking methods, malware creation, unauthorized access, or anything that helps cybercrime. This is about awareness and protection. The defensive point is simple. Any digital financial system must be built with strong security from the beginning. That includes secure user authentication, clear recovery processes, fraud detection, strong vendor oversight, protection against fake apps and impersonation, resilience during outages, user education, privacy protections, incident response plans, and clear responsibility when something goes wrong. What most people underestimate is that security is not only about preventing someone from hacking the system. Security is also about preventing ordinary users from being tricked. A perfect technical system can still be abused if criminals convince users to give away access, install fake apps, trust fake support numbers, or enter information into fake websites. That is why human-centered security matters. For example, if people hear about a future digital dollar and scammers send messages saying, "Register your wallet now," many people might click because the topic sounds official. If a fake website uses government-looking language, some people might trust it. If a fake support caller says, "Your digital dollar account is locked," some people might panic. This is how scams usually work. They borrow credibility from real institutions. Then they create urgency. Then they push the victim to act before thinking. In my opinion, the first wave of risk around any major digital finance change is often confusion, not the technology itself, confusion. Because scammers thrive when people do not know what is real yet. So if Americans want to navigate digital finance safely, they need one basic habit: verify before acting. Do not trust random links. Do not install financial apps from messages. Do not share verification codes. Do not respond to pressure. Do not assume official-looking language means official source. Go directly to official websites or your trusted financial institution. And if something sounds urgent, slow down. That one habit protects people from a lot of modern fraud. I do not think this is about being paranoid. I think it is about being prepared. Point 7. The real scam risk. Around the digital dollar here is something very important. The biggest risk for most everyday people may not be the digital dollar itself. It may be scams pretending to be connected to the digital dollar. This happens with every major financial topic. When tax season comes, tax scams rise. When student loan news becomes popular, student loan scams rise. When crypto trends rise, fake crypto platforms rise. When payment apps become common, payment app scams rise. When a bank changes a policy, fake bank messages appear. Criminals follow public attention. So if digital dollar discussions become more mainstream, scams will follow that attention. A scammer might send a fake text saying, "Your digital dollar wallet must be verified." Another might create a fake app that claims to connect users to official digital currency benefits. Another might claim there is a deadline to convert cash into digital dollars. Another might pretend to be a bank representative helping you activate a new account. Another might use social media ads claiming you can invest early in the digital dollar. All of these would be red flags. And what I personally think is important is this: official financial systems do not usually work through random pressure messages. If someone is rushing you, threatening you, promising secret access, or asking for sensitive information through a link, that is a major warning sign. The safest defensive steps are simple but powerful. First, only trust official communication from known institutions. Second, never enter financial information through a link sent by text or social media. Third, search for official information directly instead of clicking. Fourth, talk to your bank or credit union through known contact numbers. Fifth, be suspicious of anyone promising early access, bonuses, secret registration, or urgent conversion. And sixth, warn family members, especially older adults, because financial scams often target people who are less familiar with new technology. In my opinion, this is where a channel like Cyber Safety Brief matters most, not because everyone needs to become a cybersecurity expert, but because everyone needs enough awareness to avoid being manipulated by fake urgency and official-looking scams. The future of money may become more digital, but the old scam formula is still the same. Create confusion, create fear, create urgency, then ask for money or information. If you recognize that pattern, you are already safer than most victims. Point 8. Digital identity will matter more than people think. A digital dollar conversation is also a digital identity conversation. That is because money systems need to know who is using them. Banks already verify identity when people open accounts. Payment apps verify users in different ways. Financial institutions follow rules designed to reduce fraud, money laundering, and other abuse. So if any future digital currency system existed, identity verification would likely be a major part of the discussion. And this is where everyday cybersecurity becomes very personal. Your identity is not just your name. It is your email, your phone number, your address history, your social security number, your device, your bank account, your login habits, your recovery options, your documents, your online accounts. And increasingly, your identity is the key that opens financial access. What most people underestimate is that protecting your identity is now part of protecting your money. If someone gets control of your email, they may reset passwords. If someone gets control of your phone number, they may intercept account recovery attempts. If someone gets enough personal information, they may impersonate you. If someone tricks you into sharing codes, they may access accounts. So even if we are talking about a future digital dollar, the safety lesson applies today. Protect the accounts connected to your financial life. Secure your email first. Use strong recovery settings. Check account alerts. Be careful with phone number-based recovery. Monitor suspicious messages. Keep your devices updated. Do not overshare personal information publicly, and treat identity documents like high-value assets. In my opinion, digital finance safety begins before the payment happens. It begins with identity, because if your identity is weakly protected, every financial system you use becomes easier to abuse. This is especially important for small business owners. A business identity can also be targeted. Fake invoices, fake vendor changes, fake payroll messages, fake tax notices, fake banking instructions. These scams do not require advanced hacking. They require trust and confusion. So when we talk about navigating digital money safely, we are really talking about navigating digital identity safely. That is one of the biggest lessons people should take from this video. Point 9. Accessibility and the cash question. One of the most sensitive questions around digital currency is whether it could affect cash. For many Americans, cash is still important. Some people use cash for privacy, some use it for budgeting, some use it because they do not fully trust digital systems, some use it because they are unbanked or underbanked. Some small businesses still rely on cash for certain transactions, and during outages, disasters, or system failures, cash can still be useful. So when people worry about losing access to cash, that concern should not be dismissed. A modern financial system should not only be efficient for people with smartphones, strong internet, and multiple bank accounts. It should also work for people with limited access, older adults, rural communities, people with disabilities, people who prefer cash, and people who are not comfortable with complex apps. In my opinion, the fairness question is just as important as the technology question. A system can be modern and still leave people behind if access is not designed carefully. That is why any digital money discussion should include accessibility. Can people use it without expensive devices? Can people recover access safely if they lose a phone? Can older adults understand it? Can small businesses use it without high costs? Can people with limited internet access participate? Can users get help without being exposed to scams? Can privacy be respected for ordinary transactions? Can cash remain available for those who need it? These are practical questions, not political slogans. What most people underestimate is that safe technology is not only secure technology. Safe technology is also usable technology. If a system is too confusing, people make mistakes. If a system is too hard to access, people get excluded. If a system has poor support, scammers fill the gap. If a system removes familiar options too quickly, trust decreases. So whether the topic is CBDC, payment apps, online banking, or digital identity, the principle is the same. Technology should serve people, not force people into confusion. That is why everyday users should care about design, access, and education. Because security is not only about code, it is also about whether real people can use the system safely. Point 10. What Americans should watch for going forward. Short version. So what should everyday Americans actually focus on? Not rumors, viral panic posts, or random social media claims. Instead, follow only official updates from trusted sources like government agencies, banks, and cybersecurity alerts. If real changes happen, they will be announced through official channels, not random texts or links asking you to act quickly. Never trust messages just because they use words like digital dollar, Federal Reserve, Treasury, or verification. Scammers rely on official-sounding language to create trust and urgency. The safest habit is simple. Slow down and verify before acting. Check your accounts regularly, enable alerts, keep apps updated, and avoid financial decisions under pressure. And most importantly, teach family members not to trust urgent money messages. You do not need to be an expert in finance or cybersecurity. You just need to recognize patterns. Real systems do not force panic. Real institutions do not ask for sensitive information through random links. And real safety always starts with one step. Pause, then verify. Stay alert, stay informed, and stay safe online.